With BofA Securities head of U.S. equity and quantitative strategy, Savita Subramanian, who's got a year-end S&P price target of 4,300, and JPMorgan Asset Management Chief Global Strategist David Kelly, both join us here in person at Post 9. Great to have you guys here.
Great to be here.
Glad to be here.
David, does your world change based on this jobs report?
It's part of an evolving story. I think the odds of a soft landing are going up. It is a very mixed report. I mean, we lost 310,000 jobs according to the household survey. We gained 339,000 jobs according to the payroll survey. But to me, the tiebreaker here is wages. Average hourly earnings only up 4.3% year over year. You go back March of a year ago, it was 5.9%. So what we're seeing is we're not seeing much wage pressure out of this tight labor market. That gives the Federal Reserve a chance to take its time here. And then the one other thing is I am happy to see this passage of a debt ceiling bill. What it says is one of the big risks out there that they're just too crazy in Washington and they're going to plunge us into an unnecessary recession. That's kind of gone away. So I think when Steve is talking about that terminal rate, the rate next year going up, what's really going on here is the odds on a big recession or a significant recession are going down for right now.
Yeah. So do you think that's off the table as well, Savita? I mean, you just raised your price target at the end of May.
We did. Right. We raised our price target to 4,300, which is now only 50 basis points away. So it's tough keeping up with this market. I think that's absolutely right. I think the idea that we're heading into some kind of dire gloom and doom recession is a little bit harder to justify with these types of numbers. I do think that investors are positioned for a much worse backdrop than what we're likely to see. So our view is that this is actually a real opportunity to add cyclical exposure. I mean, 4,300 on the market isn't that bullish a call, but I think the constitution of leadership is going to change pretty dramatically.
Position meaning they're out of equities, position meaning they're too heavy in cash and treasuries.
They're out of equities. Okay. So I think what's interesting is that from the beginning of last year to now, at the beginning of 2022 to now, we saw about a 10% drop in allocations to stocks, and all that money moved into bonds. So there was this sort of safe haven mentality, and I think that actually bonds are looking like one of the riskiest asset classes. And most people disagree with me, but I think that in an inflationary environment, when inflation is sticky and potentially not controlled, why lock in fixed income? Why not buy equities and participate a little bit in that upside from earnings? So I think it's an interesting moment for asset allocators and investors.
I loved your line this week. I think it was something like a market teeming with low conviction bears.
Low conviction bears.
So what does it take to really push them?
I mean, it's an interesting time because I think there's a lot of career risk. It's hard to be short AI or short tech because, we saw in the first quarter that it was all you wanted to own and so far this year. But I think that the idea of why bother getting really cyclical if we are going to see a recession, that prevailing kind of mantra is still out there. So it's like, why do I want to bother? Why do I want to take that risk in my portfolio if we are heading into a recession at some point in the potential next quarter or two? But the truth is that recession keeps getting pushed out, and I think that we've been positioning for this recession for such a long time that we're actually at very conservative allocations.